All right, chat, we are back and we are live. Welcome back to this Applied MMT live stream. If you're here right out of the gate, make sure you drop a line in chat, say hi. We have a good one cooking for you tonight. Today's been a wild day. Today has been a wild day. Markets have been continue their selling and I think a complete vindication of our overall assessment here, and yeah, really vindicating deep MMT, and markets have, yeah, like I said, have really been selling off deeply. And give me 1 second. Yeah, it's just vindicating kind of the whole process here. So I'm never necessarily, yeah, I'll say it. I mean, I'm kind of excited to see how things are playing out very much as we were expecting. And yeah, you're not going to want to miss tonight. We're going to go over some of the data that I'm taking a look at that I think is the clickbait title said. I posted this on Twitter, and that was "This is huge," and it is absolutely huge tonight. In terms of the way the data is progressing, so we'll take a look at that. We will also take a look at you and your clickbait. Yes, it kind of works. If you go look at my last live stream video, I got double the views when I was doing the thing. So for whatever reason, the algo really likes the well, we know why. Yeah, this is actually important, and I have to admit the flows are kind of collapsing more than I had imagined they would at this point. So we will go over that data in just a second. I also have some tweets that I kind of want to go over. I love the reaction that I'm seeing right now in the financial world. They are thoroughly confused as to what the hell is going on, and the cycle of I don't know what's going on, but I'm still going to prognosticate and complain is continuing strong. So give me 1 second to do one housekeeping item real quick, and then we will get underway. All right, chat, welcome, welcome Brian, Stephanie, welcome. I think you're new here, glad to see you drop by. Ghost on the Half Shell, good to see you again. And then Bully Pulpit, welcome back. Let's do this. Let's start off with a look at the data. Django, glad you could make it tonight. Welcome, welcome, welcome. All right, so I tweeted this out last night. We're going to go ahead and get underway. I probably only have about an hour for tonight for those AppliedMMT members. AppliedMMT.com. The update will be posted tonight. The last of the data that I use for all the models rolls in right around 7 o'clock. And so it's usually why I do the updates either early enough in the morning to where it's applicable or late enough in the afternoon to where the data rolls in. So we'll be seeing the last of that data roll in. But like I said, if you are a member there, the complete update will be posted over on AppliedMMT.com tonight. But I do want to point out that yesterday I tweeted out that we had just a massive fiscal drain here. And what you're seeing on screen, I'll go ahead and open this in a new tab. That's bigger than I that's bigger than I thought it was going to be. There we go. We had 160 billion total drawdown or drain on Wednesday yesterday. I'm sorry, today's Wednesday. On Tuesday yesterday with the tax flow. I guess this would be Monday. Monday was the tax flow, and we had this massive drain that hit on a single day. And I don't know, you can add up the totals here for what we've got over the last 3 days, but massive drain, almost on par with what we saw in 2022. And I think I tweeted out. So the 18th is when taxes were due in 2022, and that was 144 billion. So at least in terms of in terms of the actual day itself, that was were actually bigger. I don't know how that equals out CPI adjusted, but it's pretty much the same at this point. And so really, this is a pretty big drain. What we need to do, though, and what I'll kind of explain for the rest of at least this segment here, what we need to do is look at this obviously relative to the kind of current trend of flows, and then see if there's anything that's different about this time relative to where we're at in 2022 to really kind of make an apples to apples comparison. And my argument's going to be that we have some things that were definitely against us in 2022 that are not against us right now. And so even though we absolutely anticipated the drawdown that we have and that we're seeing, I don't think this is going to be a repeat of 2022 at this point. And some of the concerns that we might have had at during the weekend and heading into this week, a lot of the geopolitical concerns, those have effectively just gone away. I mean, no one's really talking about them at this point. And if anything, I mean, I think, concerns were quelled right away. We saw, I think we've at this point, oil's down, God, almost 5% from where it was at the start of the weekend. So things at least in that front are quieting down here quite a lot. So let's do this. I think there are a couple other things that I want to point out before we go into the flows. Let's see. Yeah, let's do this. Well, no, let's go ahead and look at the flows, and then we will jump into kind of the rest of everything I wanted to look at. So here's this is the 90-day average of the fiscal of the net flow from the daily treasury statement, and as you can see over the last couple weeks here, we have been absolutely plummeting. And if you look at the exact same time frame in 2022, very, very similar look here. Peak in terms of flows for 2022 was April 18th. So again, kind of looking apples to apples, we're not quite to the net flow being negative, and that's where we would really be concerned, is if we went fully negative. And I don't think that we're going to ultimately get negative here, but we're close, and this is fairly severe. On top of that, and this is one of the things I've been really kind of droning on about for a while and hitting home on, is that we've just been on a 5-month rip, right? From effectively November to the end of March, we were on a complete rip higher, and so this is the first amount of volatility that we've seen in quite some time. And to put that into comparison, the last time we had a weekly RSI reading above this was heading into Volmageddon in 2018, and after that, it would have been the run up into the COVID sell-off. So here's the thing: you don't. And if you go back far enough, you can see RSI readings that didn't necessitate just a massive collapse. And I think this is probably more akin to where we are at now, relative to historically, say heading into the .com bubble. But regardless, we are from an RSI standpoint, from a pure momentum standpoint, we are very, very overbought. And quite often, when you get this overbought, the consequence of this is a very swift realization of that volatility. So my argument here is things could still get pretty dicey, but we're not in a position where I think we're going to repeat 2022, nor are we in a position where we would obviously repeat anything quite yet of COVID, obviously, unless another strain hits or something like that. But we are in a slightly different position than we've been in the past. But just to kind of bring out some similarities, one that does kind of look right, at least to where we're at, is the 2018 build up into February of 2018. Very similar. And then we had Volmageddon that played out. At this point, obviously, we haven't gotten quite that high. Still, though, similar, and we're kind of having a somewhat similar sell-off. Now, Volmageddon, we ended up getting, I think, like 10% one day between the beginning of the day and to the overnight blow-up of one of the VIX funds that took us lower. I think it was like a 10% sell-off. At this point, we're only down 5%. And could we go another 5% lower? Absolutely. We'll wait and see, and we'll go from there. All right. Next up, let's take a look what we want to do next. So yeah, and here just a couple other things too, at least on the short run. Again, we're starting to see volatility hit as much as we have it in quite some time. And a good measure of this is any time the Bollinger Band on the VIX gets surpassed by the price of the VIX. To me, I usually kind of count that, and it's a complete close above. I usually count that as kind of a volatility event. It's rare that it happens, and it's a good measure. And one of the things that I look for, just in passing, it's not like the core to any tool that I have, but I think it's a good approximation of where we're at. Volatility is when we pop above the upper Bollinger Band and then close 2 subsequent days below. Usually a pretty good sign that we're going to crush volatility. We did briefly last week, and then subsequently popped higher. But you can see these sort of activities that take place where we pop and then we kind of just stay up on that upper boundary of the Bollinger Band, and then we get 2 complete closes beneath, and that's usually a signal for a complete collapse of volatility. So what we are going to want to look for going forward is we're going to want to see something like that played out in late October as we transitioned into November. If you can see that volatility switch and then completely collapse, that's usually the signal that the flows are kicking back in, and that is compressing volatility going forward. And that is the look that we're wanting to see. Obviously, we have not quite reached that. We are still very extended in terms of this volatility move, and that makes things really, really tricky. So look, flows are lacking, to say the least, right now. Let me pull back up that flow chart. This is about as deep as we're going to get in terms of contraction. If we look at net deposits, let me go ahead and turn that on and zoom in to that. I'll have to pull this down a little bit. I mean, you can see that the gap between the lines, we want a big gap. That gap is shrinking very, very quickly. And if the gap between the deposits and the withdrawals flips, that means we're effectively running a surplus. And so we want that gap to stay open. That means there's ultimately still a deficit running, adding those net financial assets to the private sector. And as long as we don't get there, I think we're not going to repeat 2022. But suffice to say, a massive withdrawal here from tax day, and definitely part of the component that is causing some instability that we're seeing in markets right now. And historically too, this effect can be felt through May. I mean, in fact, usually April stays pretty condensed, and then it's May where things finally fall off. Simply because, and if you go back a couple weeks to the past few live streams, we've been kind of mentioning this, but simply because of the run-up where we were at, I felt like things might be a little bit more sensitive heading into tax day before options expiration took place, and that some instability could end up creeping in. And I think, well, as it's turning out, that ended up being a bit prescient in terms of how it played out. Speaking of OpEx too, so this is where things get a little tricky in terms of how the next week or two could end up playing out. It is OpEx week this week, so options expiration is going to happen on Friday. What does this mean? This means that all the dealer hedging, or at least about a third of the dealer hedging right now, is going to release. It's going to reset on options expiration because those options are going to expire. And a lot of the short-term fluctuations in markets happen because of this dealer hedging. And whenever you get a trend that gets reinforced, so you see a long run-up in stocks, or you see a long sell-off it's effectively like we've seen over the last, let me actually pull this up. I'll go to say like an hour chart here, right? You get these just immediate sell-offs followed by inching higher, or sometimes a bit of a bounce higher, but then just a complete slam lower, back test, complete slam lower. What's happening is those are dealer flows that are coming in and having to sell because we're in a negative gamma situation, and it's reinforcing the downside kind of potential of markets. And so it's reinforcing the downside potential of markets, and so we have to kind of escape this. And this also happens to the upside. During the upside, every single little dip gets bought, and it reinforces to the upside. We're now stuck in this negative gamma situation. So what's going to happen is on April 19th, we're going to have this, what the people in this space call the window of opportunity for this to kind of reset. And then usually how I look at this is the underlying structural flows will come in and set the next month going forward. And right now, those underlying structural flows are a bit empty, but they're just going to start to kick on right as we enter options expiration. So What I'm interested to see is after options expiration, that first week, are we able to establish any sort of rebound bullish trend, or are things still relatively choppy? Do we never see the buildup in gamma, in hedging above price? If we don't end up seeing that, then maybe by the end of next week, then maybe we end up kind of holding this overall downside risk, and we continue to have very choppy sell-off markets into the middle of May. Now, by May 17th, my guess would be flows will be established enough, and we'll just start to see the first signs of kind of a bullish takeoff, and it would very much likely happen around that May 17th, where if we continue to get selling to that point, that we would see that is the inflection point, and then the rally could emerge following that point. So that is, I guess, it's yeah. I mean, we're in a bit of a, I don't want to say peculiar, but we haven't had a situation quite like this in a while. We're in a very bullish market, hit by the large April tax strain right as we are heading into OpEx. This could reset things. The sell-off could be relatively short, or we could end up pushing through May. And I mean, at this point, Deep MMT is calling for the push through May and not looking for a big rally into May. And so, I mean, that's kind of where I'm at. I see no reason to kind of fight against Deep MMT given what I'm seeing. But that would be kind of how I see things. But if we end up kind of catching in the next week or two, and this is kind of it, then I think we could easily end up being on a run from here higher. All right, I think I've kind of hit the high notes on where we're at with markets at this point. The other thing that is different, and Chad, I'll take a look at you guys in just a second. The other thing that's different right now is, unlike in 2022, we are just starting off the credit cycle. In 2022, we had a massive kind of credit boom. Now, this is kind of a base effect from the initial burst post-COVID, but overall, we were on an upward trajectory because of the massive fiscal stimulus that happened after the COVID stimulus, or after COVID, the massive stimulus that allowed us to go on that kind of 18-month, 2-month long cycle higher in bank credit, and then we really did have in 2022 the strong deleveraging that took place. But now we are seeing that acceleration, so we're on the opposite side of the cycle. We are at the bottom, accelerating higher, whereas in 2022 we were at the top, starting to decelerate. And so we are going to have that endogenous flow really pick up here and offset some of the damage that might have been done in that fiscal vacuum back in 2022. So we do have a lot of differences that are important to the overall picture here, and kind of getting our framework in place, and that is that bank flows are starting to kick off here, and there's a lot more appetite for risk right now than there was maybe back in 2021-ish, or I'm sorry, 2022, and we just didn't have the cycle going against us. So that is a bit different as of right now, again, in terms of where we are at from a market, or I should really say like a macro standpoint. So that is how I'm seeing things right now. Again, Friday going to be a bit of an inflection point. We'll have to see how that week plays out after. I mean, we are going to get flows to turn back on. If you look at, for example, let me go ahead and reset this, and we'll just look at, we'll just zoom on in here. Hey, let's use that 2020 as a corollary. So, yeah, by the end of April, we start to see acceleration happen once again, and then we will get that June corporate tax as well. And I mean, we just got that double dip from the April tax, and then the corporate tax getting us into surplus territory. But then we had a very, very quick acceleration, and it was that acceleration in the end of or at the end of summer 2022 that really allowed us to kick off. And we had that kind of false bottom, if you will, that last push lower in October, just due to the overall volatility at the time. And then it was right around the options expiration of October that the last of the negative gamma reinforcing selling gave way, and we were able to really see ourselves emerge into a much more bullish market. So again, feeling very vindicated. Deep MMT feeling very vindicated as well. Like I mentioned during the last update, it had been for a couple weeks, 3-4 weeks, had been seeing a top in place, and then finally we saw, maybe even longer, I think, finally even saw that strong selling and 5% lower from the top in very quick succession, and we could easily end up getting deeper tomorrow and into the end of this week. And if we don't see buying catching, we could have a really nasty end of April into May. So this doesn't have to stop here, and certainly I'm not necessarily eager to get long into this market again. I mean, this is far from vastly oversold. We will inevitably get a bounce here at some point. 5,000 makes a lot of sense. Heck, even kind of the level that we're at, this 50-50 was showing a lot of support. But we will get a bounce. It's just, will that bounce actually have some legs to it, or will it give way, and will there just not be enough of that structural underlying flow really supporting at that time? All right, chat. Let's see what you're saying. If you have any questions, pop them in now. Like I said, tonight's going to be not a short live stream. We'll probably go for about an hour. But if you have any questions, make sure and send them my way. And then again, if you are watching this on Twitter again, and you want to interact with chat, the best place to do that, well, the only place to do that is on the YouTube stream. All right, let's see what chat is saying. Monique, welcome, by the way. Glad to see you here. And Django, welcome back. 270 billion drained so far. Stocks are going nuts. Yeah, it did. MMT saw this coming a mile away. We sure did. Very, very vindicating. I got to say, it does crack me up just a little bit. I'll make these posts, or my team will make these posts that are pretty straightforward in terms of just kind of basic MMT tenets. Spending is adding net financial assets or something. And I got these reply guys just flooding in. They're losing their minds when I say something just to me that is relatively straightforward and correct. And the reply guys just go at me. When they never respond to me is when I post deep MMT updates or my market calls. None of my reply guys are following up to that, because they have just been chef's kiss, baby. Chef's kiss. They've been spot on. I always, whenever I kind of make my call and I make my big pivot and I put it out there, and it's always a bit concerning, because it's like you're putting an entire theory on the line here, and yet time and time again, it's quite astounding how accurate this whole flow thing can be. I think it's twofold. One, you'd think the people that the only thing that their job is to understand where markets are heading would gravitate towards whatever it is that needs to get them to that answer. And yet so many people whose job it is to write about this, to understand this, just hate the idea of MMT, and they can't even begin to fathom that it really is just as simple as tracking flows. At the end of the conversation that Riddick Goyle had on the economic burrow, he made a really good point about distinguishing between the two kind of empirical approaches, kind of a flows-based approach and kind of an econometrics style-based approach. And the flows-based approach, which I think a lot of the MMTers and the heterodox are very aware of and are developing on top of that approach, are looking at flows. They're looking at what is truly the most of leading indicators, because this is truly the cause of all economic activity that would flow from this. And if you're looking at economic activity after the fact, so kind of the econometric style, you're only getting an approximation of what the flows look like after the fact, right? So you're always looking in the rear view mirror, and that is exactly what I'm seeing on Twitter. So we'll look at that in just a second, get some kicks off of some really bad takes. So 1% dip at FT right now. Ghost on the Half Shell, can you explain what you mean there? Not entirely sure. I'm tracking. Let's see. Mid-May, early June should be rebound, if last year is any indicator. Yeah, and that's one of the things I'll do is when I do kind of analyze things, I look at where we were at a year ago, or when was the most recent kind of corollary to where we're at right now, and see how did markets respond. And in fact, that's effectively what Deep MMT is doing. It's looking back at past price activity, seeing how the data compares to the past, seeing how price compares to the past, and then making its determination from that. So yeah, I think that makes a lot of sense, and is certainly a good a good overall heuristic to determine where markets might be headed. All right, question. I'm with you on not rushing to buy dips and get long in this market, but in the short term, during tax season, are you considering playing some inverse ETFs or selling covered calls? I don't get short here. I mean, I did hedge, so if we get a big enough sell-off, I'd get like an asymmetrical payout, but for the most part, it's effectively a cash hedge here. I mean, like I'm in cash. I don't short. I have a tool that I've developed, and I've shown it a few times on stream here, called the flow phase model, or the phase flow model, and I will only get short if that model is predicting the worst of outcomes, or the lowest possible returns that thing can create. Its classification. So in other words, if it classifies us in the most bearish of markets, that's the only time I'm going to get short. Otherwise, I'm not too keen to try and fight a market to the downside, or try and capitalize on a market to the downside, when my core model is telling me that we're in an overall bullish environment. And so I'll stay out of the short game, simply because, I mean, in all frankness, I thought as early as late February, early March, we could start seeing selling take place, and we didn't, right? And so let's just say I'm like, all right, I'm going to get my positioning right. We're going to go ahead and start shorting this market, because we know we're going to get the sell-off, and I do that short at the end of, let's just say, February. I mean, I think we still rallied 5-6% from that point into the ultimate peak that we had, and now we'd be just kind of converging on that. And then what's really tough is, okay, maybe I'm up just a little bit on a trade like that, but the difficult part would be, when do I finally get out? And at this point, I'd be getting out sideways anyway. And the best case scenario is we get absolute chaos over the next few weeks, and maybe we sell off another 5-10% like we did with Volmageddon. But getting out of that position is so hard as well too. I mean, it's just to actually cash in on the bottom tick is very, very hard. And so unless I really think we're going to get sustained selling over months long period, I'm just not going to get short. I don't even think, I might have had a brief short in 2022. Maybe after April, I might have flipped short. I don't remember. But really, it would have to be a scenario like 2008, where I'm going to feel comfortable holding a short over a period of time. And if I'm going to hold a short, I'd like to be able to hold it for 6 months to a year if possible. I mean, in an ideal situation. And obviously, every situation is going to change in real time. But yeah, in an ideal situation, like for example, well, okay, maybe 2, 3, 4 months I could see holding the short. So from like April 2022 to June 2022 would have been an ideal situation. And I'd have to go back and look at my actual trade log to see what I did at that time frame. But that would be, I would really need to see a surplus to want to go short. Otherwise, I'm quite comfortable just trying to hedge in the short run and letting it play out, and then looking for a buying opportunity from there if there's any capital on the any capital left on the sidelines. Good question, though. I mean, good question. And I got to tell you, I have subscribers. We have subscribers to AppliedMMT that are far more aggressive than I am, and have indicated as such, and have outgained me over the years. And I mean, it's just, yeah, it is a tricky game, and I'm content. I'm content having just not had to. I'm content having not been getting caught up in this sell-off at all. I mean, that's a win for me. So, and I think during the last stream I gave, maybe it was the last stream, or maybe it was a few weeks ago, I gave that the analogy of the golf course and the various holes that you run into along the way, and to me, just getting a par right now is good enough. There was no need to go for a birdie here for me, but if you're a better golfer than me, and you feel confident with the putter or the short game, and you know how to get yourself out of sand traps and whatnot, then by all means go for it, and more power to you. I think a handful of people have told me they are kind of net short here, so good for them if they were really able to capitalize. All right, so stuff like this from I'm assuming Financial Times, the debt. Yeah, we'll talk about the Financial Times post in just a second, and I'll be bringing that up. I thought there's been some great tweets. All right, let's move on to what else I wanted to talk about tonight. Actually, I'll bring this chart up too, and just to kind of show this is the monthly comparison chart year over year, so you can see kind of where we're at. And April will continue to drain for the remainder of this week, and I think we will end up with a drawdown akin to where we were at, somewhere in between 2023 and 2022. But in terms of what really matters, like that year over year surplus, I don't think is going to happen. I just don't think we're going to get as bad as we were in 2022. So right in between, but enough of a hit, enough of a shock to the flows to justify taking that evasive action that we did, and we'll see how things play out going forward. All right, let's roll through some tweets that I at least wanted to mark. I continue to see the Atlanta Fed predict a push up here in their GDP nowcast, or their real GDP nowcast, and no surprise. I mean, consistently we're continuing to see those econometric tools, right? Like the GDP now, or the various indicators after the fact, starting to really show again a good boost in strong growth here. Also, and Mosler points this out as well. It's really the blue chip consensus starting to catch up to reality too. So more and more people are starting to see reality here. Now, are they realizing what we realized a year and a half ago, and have they fully pieced all that together? I don't think so. I just think it's more of a this market's acting irrational. My good buddy Bob Murphy, who I believe is talking at my alma mater tonight. I almost took off. It's only about an hour and a half away from here, and maybe we could have tried to meet up, but I wanted to make sure that this stream was important. We're seeing a lot of selling, and it was important that we had this stream. But he's having a debate up at my alma mater. He had his Austrian take on where markets are headed, and it was. I mean, I'm always curious about how people who got it really, really wrong, are they just willing to kind of double down and say, it's still going to happen, and that was exactly his take, or nope, I've really learned something. I think I had something wrong, but his take was just to double down. And it's interesting to see kind of the copium right now as people realize that they were just completely wrong now, a year and a half later after the realization. And if anything, too, it's not even like we're teetering on recession, right? I mean, we are getting strong GDP growth, and this is very much no surprise. This continued surprise to the upside pattern that we're seeing from all the various indicators. So very, very strong growth continued. Now I want to get to the fun stuff. I'm actually going to start with this Bloomberg article. And it's just, I think we might have tweeted this out. A radical theory is spreading as economy defies expectations. The reality is people have more money, one convert says. So there is, we actually reached out to this person, I think, and really cool person. And I think we are going to be able to chat with them at some point. But glad to see it's catching on. I mean, at some point, in fact, I mean, we're kind of seeing this, right? Because we're seeing the absolute cycle play out, right? My favorite, Daniel Lacalle. Inflation is a huge advantage for the currency issuer. It blames everyone for the rise of price, except for the only thing that makes aggregate prices go up. Consolidate that, increase and continue to rise, even at more moderate rate. Printing more currency than the private sector demands. So the copium is hitting in, right? I mean, it goes from which is really wild, right? So it goes from we are going to have a recession, right? So I mean, a recession is a contraction, and we go from we're going to have a recession to crying about inflation at this point. I didn't read the article, but I mean, I'll say it out loud. I'm not. Inflation is not a bad thing. I don't know any way to put it. I'm okay with inflation as long as we're seeing growth outpace inflation. I'm okay with inflation, especially when we're seeing production kick higher, growth kick higher, hiring kick higher, wages continue to push. Inflation always needs to be seen and understood in the context of the broader macroeconomy. And I think there is some benefit to dissuading hoarding of cash, right? I mean, especially dissuading hoarding of cash when you start seeing disinflationary pressures, because that can just exacerbate the deleveraging that takes place in a contraction. So there are elements of inflation that I am okay with. I also think it's just a bad idea to encourage saving in the currency of use that the government is issuing. I mean, I think we should encourage investment if you're going to have investment outside of the currency. Now, I'm not saying that we should be debasing the currency, right? I'm not saying that we should be issuing debt in another currency and then paying that debt off with our currency. But as long as the spending is showing productive output or can be tracked back to some productive capacity, then I think the spending is or the inflation outcome of that is okay, and I'm okay with that, and I'm not too concerned with that. Now, when inflation gets out of control because of supply side shocks, that's the sort of inflation we have to be concerned about. Certainly, too, inflation plays a role when you look at spending, deficit spending in real terms, because that's when you eventually get, in real terms, that surplus to take place, and that is when the instability kicks in. And so from that vantage point, we want to be careful, but we're not there yet. So they will continue to cry, continue to cope. It is the cycle continues, though, and they will jump between fear of collapse and fear of inflation. And they'll continue to promote gold at the expense of the dollar, which is fine. I mean, if you want to buy gold, knock yourself out. We've made the case many, many times why I think gold could and should continue to outpace here. And I think it's an absolute. And I love the way that Warren put this. Gold pushes higher, and I got to build a model based on this theory, right? That gold pushes higher when the lowest propensity to consume people are getting the most amount of money, right? I mean, there's got to be something there that the only people buying gold are going to be the wealthiest that are having extra funds. So there's got to be something. There's got to be something there that whenever the spending is hitting the top quartile or whatever, that correlates with gold. Because one of the things a lot of the gold bugs are pointing out right now, and it is interesting. We actually had a write up at AppliedMMT. I'll plug the site, a free article, free write up. That we posted. Gold's recent run doesn't mean what many think that it does. Really good write-up, but it is kind of interesting to see the gap between gold usually tracking real rates, and as of late that has not been the case. There's been a lot of demand for that. And speaking of the site too, while you're over there, our conversation with David Andolfata was published yesterday, so it's a pretty good conversation and a good kind of debate. I mean, it did get a little debatey at times, so that was a fun discussion, and I really appreciated having him on. So that is worth a listen, and the podcast is out on the site. But anyway, yeah, going back to the gold stuff, it's pretty obvious that that. And that's the other thing too is they want government spending to end, but then they also want people to buy a ton of gold. Like, that's their recommendation. I don't know. They need to make up their mind. They need to figure it out. All right, Chad, I'm seeing a few more comments come in, so I will jump back over to you real quick. Let's see. We have Hamel Gold. I'm assuming GS and MS both had strong Q1 earnings beats. I'm going to assume that's Goldman Sachs, and is MS Microsoft earnings beats, or is that Morgan Stanley? Investment banking and wealth management seems strong. Yeah, I mean, it absolutely is. It's going to be strong, and with rates pushing so high too, and now that deposits are catching up to that, I mean, there's now this funnel to depositors, and depositors are certainly, I mean, if they're seeing 5.5, I don't know what CDs are at or whatever, right? I mean, money, any relatively safe money market fund. I mean, I'm sure it's very easy to get 6% on your money right now with very little risk, and certainly it's going to be the investment banks that are going to be matching those up for you. And there's a lot of deposits out there. They're going to keep growing because the that interest income is going to keep on pushing higher. Ghost on the Half Shell, not a fan of inflation, and you don't need it to stop hoarding cash. Yeah, I need a better way to phrase this, because it's not like I want inflation per se. Certainly. I mean, my wife has explained to me many times that crap is really, really expensive at the grocery store, and it only keeps on going higher. I think she was telling me. So we have a family of 6, and I mean, as the kids get older and that sort of thing, obviously they eat more and whatnot. But I think our weekly spending at the grocery store from effectively, let's just say when I moved to my new house back in really early 2020, I think we were almost up 100%. I think we've almost doubled, maybe not quite, maybe 75%. But I mean, and that sucks. There's no doubt about that. That's no fun. But on a macro level, and I'm going to take it away from the individual level, on the macro level, that does put upward pressure on wages. That does keep the job growth, the job changing dynamic at play. So on the macro level, there's not an immediate necessary downside. I mean, it can develop over time. So I'm not saying it's great, and certainly my detractors, if they're hearing this, are going to love it. But it is. I don't see inflation as the immediate threat that most people do. Can it become a threat? Yes, but is it an immediate threat? Not necessarily. And I mean, I think there's ways around it. Yeah. All right, let's see what else we got. Ty, is my man Doug picking on mainstream economics again? I wish there was a better catchphrase, because it's like I want to be able to MMT. That's just 3 letters. I mean, what a great name, right? The rest of the schools of thought need to come up with better names. When I put Austrian in Twitter, I always think to myself that, like, the Austrians are going to get mad at me. The Europeans are going to get mad at me. People might be confused. Monetarists, that's just a lot of letters. Neoclassicals, that's too much. So they need better, shorter acronyms or something like that, like MMT does. But yes, I'm picking on the mainstream. They deserve it. AppliedMMT has been right. We have the track record to prove it. For gosh sakes, none of that is debasing. Correct. I think that's the best part, too. I think this is the absolute best part of what's played out over the last 10 years. Give me just 1 second to pull up the dollar index here. And let's see. My favorite part of this, bear with me. I've got some drawings on here. So we'll just hide those real quick and zoom on in to the dollar index. But I've pointed this out. The U.S. has outspent the rest of the world, and certainly the rest of the developed world, by a lot. And if you extrapolate this out, the dollar's up 50% during that time, right? That is just too good. That is too good that the dollar has not only has the U.S. printed more than anyone else, our stock market has done better, our economy has done better, and the dollar remains very, very strong globally at this point. So out of all the concerns that the mainstream has had, none of them have come to fruition since their main concern started in 2008 with the response to the great financial crisis. So I freaking love it. I love it. It still blows my mind that they don't realize this, but give it enough time, I guess. Give it enough time, and then it eventually will happen. I mean, I bet their great-great-great-grandparents told their great-great-grandparents and down the line that eventually it's going to happen. Eventually. Buy dog food for the kids. It's a bit cheaper. Yeah, not a bad idea. Although that'd be a little rough for them. That's a good dad joke. All right. Let's see. Let's go ahead and finish off with... Also, hello, Vlad. Welcome to chat. Let's go ahead and finish off with a few of the final tweets that I wanted to cover. We got the Financial Times. U.S. deficit poses significant risk to global economy. Warns the IMF. So they're concerned once again about the size of the deficit. And then I thought Stephanie Kelton had some really good takes on this. The massive deficit. Financial Times, deficits are stoking inflation. CBO, spending on interest, is the fastest growing part of the federal budget. And interest rates will have to remain more inflationary for longer. And I think that the IMF said the country's fiscal deficit had contributed 0.5% to core inflation, a measure underlying the price pressure that excludes energy and food. That means the U.S. interest rates would need to remain higher for longer to bring inflation back. What? This is so backwards. How do they write this and the dots just don't connect here? All right. The country's fiscal deficit has contributed 0.5% to core inflation, right? So I'm assuming that that's not 0.5% of the rise. I'm assuming that that's 0.5% in total of wherever core inflation is at. And then a measure of the underlying price pressure, explaining what core inflation is. That means the U.S. interest rate, which has been that's $1 trillion over the last year, and the predominant piece of growth that we've seen, accelerating deficit spending over the last year and a half. How do they connect these dots? I mean, how do they do this? If that is contributing to inflation, why would you think that doing the thing that has contributed to inflation over the last year would somehow stop this, would somehow negate this? I don't get that. I don't get this is a bit maddening, really. We'll see. I don't know. I'm gonna pull up the CME. I haven't looked at that in a while. A couple days here, so we will bring that up. Obviously, no cut for May. No cut at all for June. Now, let's see. I haven't looked at July in a couple weeks or a week or two. Okay, no cut, almost certain for July. Cut by September. Okay, so I mean, cuts are off the table through June. And now September. Now it's a race to September. Remember when it was a race to March? And now it's a race to September to see better than expected outcomes. I got to clip our conversation we had at the start, or maybe it was the end of last year, the podcast that we had at the end of last year, and make that a short or something. Let's see, which podcast was it? 2023 wrap up. This one right here at the very end of it, I called it out that we were looking for no cuts, higher markets. I forget what the third thing was. Higher oil prices. I think those are my 3 calls. I think Adam, was it this? Yeah, this is the article too that summarizes it too, if you want to see it. But I think that was effectively where we were at the. So here's my call. This must have been ChatGPT because I don't think I spoke this eloquently. But I think we're going to continue to see fiscal growth, but it's going to be slightly slower pace than we saw in 2023. In terms of that, the change of growth of fiscal, that means then that bank credit needs to start expanding. Ooh, God. I was so right. Bank credit needs to start expanding, and that bank credit is going to expand. The endogenous cycle will grow at a faster rate, which wouldn't be too hard in 2023 because we actually saw a contraction. So with those two things in mind, that we're going to see an expansion on both fronts. God, I was so right here. One is going to be slower than the other relative to where it was in 2023, that being fiscal, but that means by the end of 2024, I think we're still going to see markets higher, and that we're still pretty strong. All right, I think we will also see, and here are the fun calls, I think we're going to see inflation higher, okay? All right, I think we're going to see things like oil higher, and then I think ultimately we're going to end up seeing the Fed funds rate at the end of 2020 higher, I called for higher at the end of 2024 than it currently is right now. Here's how we're going to get there, and here's how I could be completely wrong. Now, I can be completely wrong about the second half, but still be right about the first half. I think that's very possible. Here's how we're going to get there, though. We are in a race. This is what I was thinking of. We're in a race to March 20th. On March 20th, that is when the Fed has indicated they will likely make their first cut. What we need to see up until March is economic data continue to come in hotter than expected, inflation continue to come in hotter than expected, and employment continue to come in hotter than expected. We'll have 3 prints in January, February, and then March before the Fed data will come out, and we'll see what happens. All right. I think I called it pretty good. I think I called it pretty darn good in terms of where we're at. And I guess on that front, we're right back to where we were in March now for September to see if that plays out. And if we can get cuts by September, I don't know. Maybe if we do get cut in September, that could start the pace. I know Biden has kind of told the Fed they need to cut by September, so maybe they will throw a conciliatory cut like a quarter percent or some 25 basis points or whatever, but I don't think that would derail things too much overall. If we did just get, I don't think that would necessarily collapse things at that point. The last thing I wanted to look at tonight is just the reality that everyone's coming into about this is great. I love this. My team tweets on my behalf now, and the tweet for this itself was pretty funny. And I saw this come up in my feed, my own tweet, and in my own feed this morning, and it was despite Bank of America can't touch this. Despite big Fed hikes, U.S. super core inflation rising fast. And again, I think we're right on this. I just think we are absolutely being proven right on this, that the overall inflation rate is converging at the policy rate, and that's really no surprise here. So will it get as bad as 2022? Only time will tell. But at this point, certainly the hopes of inflation staying steady remain dim. And again, I don't think this is end of the world inflation at this point, but we've talked about many times the path to get there, and that is going to be oil higher. That is going to be producers, sellers raising their prices to kind of cash in on what is a very strong economy. So I do think it is quite possible that we end up on that path. All right. Any other questions? Chat, and we will go ahead and answer them. I want to see if I left anything out. I don't think I did. So I'll take a look at chat one last time. I saw some things coming in. Let's see. Yeah, the logic of the IMF is a puzzle. They need an excuse to lower rates, even though the economy is strong. I've had this question come up a few times just about, does the Fed know they've got this backwards at this point? And I believe there have been papers that have been written that acknowledge the fact that there's the potential for higher rates to be inflationary, especially in the channel of, or through the channel of, fiscal spending. And so I don't think they thought it all the way through. I mean, I really think they're stuck in this marginal propensity to consume versus save, and that there's just this monetarist knee-jerk reaction that takes place, and that it will undoubtedly, higher rates will and always have to be anti-stimulative, destimulative to bank credit expansion. And so that is the part that I don't think they fully understand. And again, I think the whole idea from our standpoint, from my standpoint, is higher rates are actually stimulative because higher rates are really and truly free money, right? I mean, it is the free lunch that everyone thought we had in the post Great Financial Crisis actually playing out. So I don't think they have it pieced all together. And I really think they think if they were to cut rates that might be too stimulative here, right? So I don't think they would cut rates to try and in any way get in front of inflation. I think they would try and do it. I don't even know why they would do it. I just don't see them cutting at this point. I don't see them cutting. I just don't. I mean, unless markets, I just don't see it. I don't see a path. Maybe I'll be proven wrong, but I don't see how they cut. I mean, I think the end game happens in 2025. I just don't see a cut happening anytime soon, and I don't see them start to cut until just the natural progression of the endogenous cycle plays out. So that's kind of my take. That's my take. I'm sticking to it. Maybe I'll be wrong. Maybe I'll be proven wrong. Maybe they really won't want to get a cut in, but we'll see. We will see. All right. Ghost in the Half Shell question. So is it possible that debt scolds immolate economies everywhere? You're going to have to explain to me. I'm only good with one or two syllable words, so I guess scolds is one syllable. But I'm assuming you mean by this, what you mean by this is those that are worried about large deficits ultimately end up kind of destroying economies within everywhere. Yeah, I mean, that will, cutting debt. Yeah, I mean, I think, interesting. Actually, this is really interesting. I saw a tweet somewhere. They were complaining about this, of course, but France is starting to diverge. I actually have a moderately good feeling about France here. I'm gonna pull up. What are the CAC 40? Right, that is the French markets. Let me pull that up real quick. And I don't know, where is France? What is... This is ugly. Sorry, I've got the bars still on this chart. It's like hurting my eyes to look at this. How do I turn color theme? And we're going to go lineless here. There we go. And so now this is log. Anyway, I do know France's spending has really started taking off. I also know that France is very concerned about the military situation that they have found themselves in Europe, and that their military spending is also taking off quite a lot. So someone posted a chart that France has outspent Germany by a ton over the last year or something. Of course, they were saying this is really concerning for France, but I should be careful with how I state this, because I'm just not terribly familiar with the every detail of Europe and what the implication is of France. But I do know they want to start increasing production, and I do know they are very very keen on kind of expanding their monetary output. I'm sorry, their actual real output, and are not terribly worried about any monetary consequences. I'm trying to think, what is the DAX? But if we're gonna go DAX futures, maybe I want indice. This be it? All right, we're gonna plop this on here, and let's see France versus the DAX. So we have, I mean, they're in lockstep. We'll go daily. These seem a little too close to me, but I think I got this right? So France slightly outpacing the DAX, right? Am I looking at the right line? Yeah. So France slightly outpacing the DAX here, but still pretty much in lockstep. No real divergence between the two. Either way, I mean, I think Europe's taken a lot of strides here. So just in terms of how they view monetary policy, so I think there's hope. Pre-COVID, that was going to be a bit concerning, but post-COVID, and certainly if the agreement in Europe is that production creation and production capacity needs to come online out of kind of existential fear, then I think the outcome of that is massive monetary and fiscal expansion in Europe, which will only be good for European assets. So some potential there. I think I saw something. Yeah, Macron is a neoliberal or has that leaning. Yeah, but maybe he's also learning too. I mean, there's a distinct possibility. All right, I'm going to go back to chat here. See what we got going on. People should find an article titled "The LL Mentalists Effect." Depends on who owns the debt. That's interesting. I'll have to check that article out. Bill Mitchell, Tuesday blog, describes everything you know about the IMF. Yeah, the IMF has not been the best institution for global monetary implications. I think the nasty consequences for nations that hold debt in U.S. currency. I agree. That is something that gets people in trouble. Viva la France. Yes. Yes. Jay Mills, good question. Appreciate the podcast. What was your takeaway from chatting with Andalfada? It was a good discussion. I really, really appreciated him coming on. When I have conversations with people that I know are very bright, that have thought things through, that are in the mainstream, right? I do get, and I think are steeped certainly in a more classical understanding of economics than I've ever been in. It is difficult to talk to some of them. Not David, he was great, because I have the language that I have to explain, my economic understanding is admittedly much more novice than their language, right? And it's hard to get in a discussion with the someone like David, knowing that I'm kind of at a disadvantage in terms of how up to date I am with their theory. Once I can get through that, though, and I can articulate what it is and how it is that I see what I see, and we can have a good conversation where we're not talking past each other, and we can kind of understand where we're at, where each person is at. If I can get there, then I can feel pretty good with the conversation, and we did get there. So in that aspect, I felt very good. My final takeaway right after we got done with the conversation is I felt more confident than ever that what I'm seeing and what I'm saying is just not anything that's been incorporated into the broader mainstream understanding, right? I guess my worry was in a conversation like that with someone who's very learned and whatnot, is they're going to say, oh, hey, that's cool and all, but you never thought of this, right? And that never happened. I mean, it was very clear that it was their side that had never thought of this, right? And the fact that there was a point where we had pointed out that in 2022 we saw a massive contraction in fiscal, and that really led to the collapse we saw, and that is just not looked at. That is just not understood. I don't know. I mean, that was, I guess, the lack of, I don't want to say awareness, but the lack of like having worked through some of the MMT implications in their broader models. is just stunning. I mean, it really was just stunning. And I felt very, very confident when it was all said and done that we're not missing anything, and that what's playing out is perfectly explained by the overall framework that is MMT. So, yeah, when we were done, I felt confident we were very much on the right track. With that being said, he was great. I mean, it was great conversation, and I know. I mean, a few people told me like, "Wow, you really kind of pinned him to the mat and stuff," and it wasn't what I was attempting to do. But there was only you only get one shot to have ask the question, and I really thought the questions I had at the end. I'm forgetting there was one question in particular. I think one of the questions I had was kind of the trickle down effect of the interest income heading to offset any downside effect that you might get from credit demand. And I just don't think that, I mean, that was clearly something that just is not in their models at all. There's also the effect of banks actually being more willing to walk up the risk curve because of the inherent hedge that the higher rates give them in terms of kind of their basket and their allocation of assets. So that was not in any way in their equation, and I mean, I think those are the two biggest things that are missing, and those are the two biggest things that I've been trumpeting for a year and a half. And I think that's why the vast majority of people to this point in this kind of finance macro econ overlay just have completely got it wrong. So yeah, it was a good conversation. Really glad he was willing to do it with us, and he's been a good sport, willing to engage with MMT. And yeah, thought it went off well. Yeah, one consideration is the EU stepping in with sending aid to Ukraine. Exactly. I mean, they it is an existential threat to them, certainly, and I think there would be a little bit more worry in the U.S. too if this was happening at our doorstep in terms of our desire to support financially, and then obviously with military equipment. All right, that is where we are at tonight. Just a reminder, if you are a member over at AppliedMMT.com, I will be having the big update tonight, the market update that will be posted, and hopefully all the data will be in at this point. The AAII sentiment, which I've been very curious about, comes out a little late. Or it's coming out a little late today. Usually it comes out right at close, but that's something I'm going to be curious about to see how sentiment is readjusted relative to flows. But we will have that update tonight, probably one of the more important updates we've had all year. I mean, this entire year has just been straight higher. So we'll have a lot to cover. But again, if you're a member there, we will have that posted tonight. Other than that, chat, I think that is where I am going to finish things up. So until next time, I think I will be back. I'll be back on Friday to finish out the week. But yeah, until next time, good trading, everyone, and we'll see you then. Have a good night.